Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. In this video, we'll dive deeper into the risks of investing in office properties within declining urban areas. You'll see how vacancy rates, shifting work trends, and population decline can quietly erode property values and investor returns over time. Underwater assets: the reality of falling property valuations. The value of an income-producing asset like an office building is based primarily on the net operating income, which means the rent it collects minus its operating costs. When a property is half empty and the rents you can command are low because nobody else wants to be there, the net operating income collapses. If the net operating income falls, the market value of the structure drops severely. Many older properties purchased before 2020 are now worth significantly less than their purchase price. This puts the owner in a dangerous position, owning a property that is worth less than the loan they took out to buy it. This situation, known as being underwater, traps investors, making it impossible to sell without incurring massive personal losses. The loan danger: banks are getting nervous about renewal. A major concern is the commercial real estate credit crunch. Many large loans or mortgages secured by these older office buildings are scheduled to expire soon. When these loans mature, the property owner must either pay off the debt or refinance it with a new loan. Lenders are now reviewing these assets with extreme caution. If a bank sees high vacancy and low expected renewal rents in a declining market, they are highly unlikely to refinance the loan. If the debt is not renewed, the owner must find huge sums of cash immediately to pay off the old lender. When owners can't find the cash, they face foreclosure. This systemic issue will create massive distress sales in these struggling markets, further driving down already depressed property values for everyone else. The cost of modernization: older buildings need expensive upgrades. Even if a declining city manages to attract a single promising tenant, that tenant will expect modern office standards. Today's businesses don't want outdated lobbies, poor air quality, or slow connectivity. They demand high-efficiency HVAC systems, which reduce operating costs and meet modern health standards. Smart technology infrastructure: fast fiber internet, reliable power backups, and automated security. Flexible, open-plan layouts to accommodate hybrid and collaborative work styles. Many older office buildings lack these features. The capital expenditures required to bring a 40-year-old building up to modern Class A standards can cost tens of millions of dollars. Since rental incomes in declining markets are already low, there is almost no conceivable way for an investor to recover that massive modernization cost. The investment becomes a money pit where capital is constantly poured in, but profitability remains elusive. Investors should only consider this risk if they are certain of a future return, which is highly unlikely in fading metropolitan centers. Focus on alternatives, not fading office towers. The data is clear. Office space everywhere carries risk, but holding or buying office buildings in cities characterized by long-term financial and population decline is nearly guaranteed to result in poor performance in this video. The economic fundamentals simply don't support the asset class in these locations. High vacancy rates combined with maturing debt cycles create a perfect storm of financial pressure. Smart investors must shift their focus to assets that benefit from growing trends, not assets collapsing under old ones. Instead of office towers, look for specialized real estate that supports modern logistics and demographics. Consider safer alternatives like industrial warehouses and logistics. These directly benefit from e-commerce growth. Data centers: essential infrastructure for the global cloud and technology sectors. Specialized healthcare facilities, driven by aging populations and stable demand. Multifamily housing: especially aimed at growing secondary and tertiary markets that are seeing population influx. These alternatives offer stronger cash flow potential and face fewer systemic challenges than the outdated, often empty office space plaguing declining city centers. Protecting your capital in the coming year means understanding where the long-term demand truly exists, and that place isn't the downtown office block of a shrinking city. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.